You don't need a receipt to give away anything to Goodwill or Salvation Army. If it's up to $500, I don't need a receipt. But if anything over $500, as long as I have a receipt, I can take that deduction. So if you're going to be doing a little house cleaning in the next 6 weeks, people, anything in the garage, anything you want to take down to Goodwill, it's fair market value or whatever you paid for it, and whichever's less. So if you bought something for, let's say it's treadmill that's just sitting in the garage, you spent $2,000 on this crazy treadmill, but you could sell it on Facebook Marketplace for $1,000. You get $1,000 write-off. Just get a receipt, you got it. So keep all those receipts, and you can stack on it $500 of non-receivable donations.
This is legit, never verified. Now, I will say this, the de minimis amount, the $500 de minimis amount that does not require a receipt in order to back up that particular utilization of a donation in order to offset taxes is quite correct. However, once you go over that amount, there's some things to be considered. Like, for instance, if you're donating something that has more than $5,000 worth, there's actually more forms that you have to fill out in order to justify and authorize, if you will, on your tax return, that itemized deduction for that particular donation. But with regard to the concept of itemized deductions, it's an important point to consider, because the reality is, over the course of the past 30 years of me really engaging with business owners, helping them figure out how to structure their financial life and structure their businesses to make sure that both are really truly dialed in, I've seen that the vast majority of business owners are actually not going to itemize their deductions because of the standard deductions. Standard deductions tend, especially over the course of the past number of years, tend to actually give many individuals a greater benefit rather than going through the itemized approach. I do want to be clear in that I honestly do not believe that the tax tail should wag the dog when it comes to donating. If you care about a cause, you shouldn't be doing it simply to get the tax deduction, right? If you care about a cause, you're doing it in order to benefit that particular cause. So be sure to continue to donate to those causes that you do care about, regardless of whether or not you get a tax deduction. Now, if you do get a tax deduction, that's a sweet bonus. But there are limitations, right? There's limitations with regard to non-cash contributions, as an example. So if you're going to give clothing or used materials, right, you're going to be limited first and foremost to the actual fair market value of that environment. And the IRS actually has a publication you can look to in order to get an idea as to what the fair market value of certain things may be. The other context is understanding that there are also limitations with regard to the amount that you can give when we're talking about physical things versus cash, right? So when it comes to physical things, typically most business owners will be limited to a maximum of 30% of your adjusted gross income, whereas cash, the vast majority of individuals would be limited to 60% of their adjusted gross income. But again, regardless, everything is going to be limited in general with regard to whether or not your itemized deductions surpass what your standard deduction benefits would give you. When it comes to figuring this stuff out, you want to make sure you're sitting down and talking with the right strategist, tax strategist, to help you make the right decisions that lead to the best outcome for you. Now, notice what I said there, tax strategist. You see, the vast majority of business owners, they're actually relying on their accountants to help them reduce their tax burden. And the sad truth is the vast majority of accountants, no fault of their own, the vast majority just tend to be more on the compliance side of the spectrum, right? They're glorified historians. They're spending most of their time, effort, and energy just trying to figure out how to best tell the IRS what already happened. It's a yesterday job, whereas tax strategists are engaged in proactive planning, figuring out what to do tomorrow, next week, next month, next quarter, the remainder of the year, right? To figure out how to reduce your tax burden in the year ahead. Like figuring out which steps to take matter. And talking with the right professionals matter. Now, that doesn't mean you don't talk with an accountant in order to do tax prep, right? The compliance requirement is a requirement. You have to file your tax returns. But when it comes to smart business owners are always looking for information and transformational actions that they can take, those action steps that lead to the outcomes they desire. Now, I have no idea whether or not I would be a fit to help you make those types of decisions. What I do know is that you can click the link in the description below and find out for yourself.